Welcome back to the
Madre mía, lo
Disciplined
hemos perdido
Investor.
todo.
We are diving deep today, getting past the charts and the technical indicators and staring directly at the biggest obstacle any trader faces. And it's not the market. It's the person in the mirror.
That's exactly right, A. It's a pleasure to be here. We're talking about trading self-sabotage, and it's arguably the single most devastating force in a trader's journey. Most people fail because of poor self-management, not poor analysis.
I love that framing. Poor self-management. For anyone listening right now who's maybe frozen at the last second before executing a perfect trade, or worse, who's just wiped out 3 months of profit in a single week of impulsive decisions, what is self-sabotage in plain English?
In plain English, it's any action or inaction that completely contradicts your own meticulously planned trading strategy, consistently leading to losses. It's crucial to understand this is not a technical mistake. You didn't misread the RSI. This is an emotional failure of execution.
That's a powerful distinction. So it's not an accidental misclick. It's a deliberate yet irrational act against your own best financial interest.
Exactly. Think of your trading plan like a GPS route. Self-sabotage is deciding mid-journey to ignore the GPS, take a random unmarked exit, and accelerate recklessly into the fog, even though you knew the original route was the most efficient. It manifests as things like moving a stop loss because you can't bear a small loss, or revenge trading out of boredom or frustration.
Revenge trading. We've all been there. It's that feeling after a loss where you must get the money back right now, and you end up doubling the position size on something you haven't even analyzed. Context. Why this matters today. So, why does this matter now? In today's hyper-fast, decentralized market, why is this internal struggle more critical than ever?
Because speed and leverage amplify emotional reactions. Years ago, you had time to wait for a fax or a phone call to place an order. Now, you can lose 50% of your capital in minutes from your phone. Our brains, as the source material mentions, are wired for survival on the savannah, not for high-frequency financial markets. Fear and euphoria, those evolutionary responses, are precisely what sabotage us at the trading terminal.
Right. The fight-or-flight response kicks in when you see a deep red candle and you react instinctively, like running from a predator, instead of analytically, like a portfolio manager.
Precisely. And what's more, this self-sabotage is rarely a one-off mistake. It's a persistent, self-feeding pattern. It's what we call the vicious cycle of financial self-sabotage.
Core discussion. The vicious cycle. Let's break down that cycle. For listeners who feel trapped, recognizing the stages is the first step to breaking free.
Absolutely. The cycle typically has 4 stages, and they happen fast. Stage 1, the desire for compensation. You follow your plan, and the trade results in a valid, planned loss. It's frustrating. Instead of accepting the loss as an operating cost, you feel an irrational, fiery urge to recover it immediately. That's the birthplace of revenge trading.
That moment of frustration, you feel like the market owes you something.
It's a profound sense of injustice, which leads directly to stage 2, the impulsive action. You bypass your analysis, you double the risk, you jump into an unfamiliar stock or asset, whatever it takes. The critical point here is that you knowingly violate your own manual. You know better, but you do it anyway.
And then the inevitable happens.
Stage 3, the aggravated loss. The impulsive action, predictably, results in a loss much larger than the original, often wiping out days or weeks of work. That's the spiral moment where despair sets in.
And the final stage?
Well, stage 4, the feeling of guilt and shame. You mentally punish yourself. You beat yourself up. And what does that do? It drastically weakens your internal confidence and authority. You promise you'll never do it again, but that destructive pattern has just been reinforced in your subconscious.
So the guilt from the failure actually sets the stage for the next failure. It's a truly vicious loop.
It is. And the most practical and immediate tip to break it is deceptively simple. physical disengagement. After a loss, physically get up from your chair. Walk away from the screen for 15 minutes. That physical timeout is just enough to interrupt the emotional impulse before it turns into a stage 2 action.
That's fantastic, actionable advice. Let's pivot to another common self-sabotage trigger, the perfection fallacy. I think a lot of retail traders assume that if they have a perfect system, it should win 100% of the time, and when it doesn't, they panic.
It's a monumental trap, especially for analytical minds. In finance, probability is king, not certainty. A great trading system might only have a 60% or even 55% win rate. Self-sabotage often happens during that 40% losing streak. The ego can't tolerate it.
They experience a few losses in a row, they tell themselves the plan is flawed, and they abandon the system right before the next profitable streak begins.
It happens all the time. That's where discipline fails. They are confusing the system failing with their discipline failing to follow the system. It all comes back to managing your emotions. As that famous quote goes, the market is a mechanism for transferring money from the impatient to the patient. The market rewards patience for the plan to play out over the long term.
Deep psychological drivers. So if that's the mechanism, what are the deep-seated psychological drivers? You mentioned cognitive biases, the mental shortcuts our brains use. Let's dive into the work of behavioral economists like Daniel Kahneman and Amos Tversky.
These guys are essential. Their work shows that when money is involved, human decision-making is systematically irrational. Let's start with the one people find most counterintuitive: fear of success versus fear of failure.
Okay, fear of failure is easy. Paralyzing, being afraid to click the buy button, missing valid trades. But fear of success? That sounds like humble bragging.
It's far more insidious than that. Fear of success occurs when a trader is nearing a new profitability peak, a level that implies a new identity, being a successful trader. That new identity comes with immense pressure, the pressure to be consistently profitable, the fear of losing those significant gains, and the responsibility of managing larger capital.
So, the success is stressful and the subconscious says, I want to go back to my comfort zone.
Precisely. The subconscious activates a defense mechanism, self-sabotage. By breaking the rules, by giving profits back, the trader reverts to their emotional comfort zone where expectations were low and the pressure was off. They were happier being the aspiring, slightly struggling trader than the highly successful, highly pressured one.
That's a huge insight. Now, let's talk about the bias that is arguably the most financially devastating. Loss aversion.
Loss aversion is the pillar of behavioral economics. They found that the pain of a loss is approximately twice as intense as the pleasure of a gain of the same magnitude.
Twice as intense. That explains everything about bad trading habits.
It does. It guarantees the self-sabotage formula: let losses run and cut gains short. Think about it. The pain of accepting a stop loss is so great that the trader would rather move the stop loss order, holding on to the losing position, hoping it recovers. They are evading pain.
They turn a manageable $100 loss into a catastrophic $1,000 loss, all to avoid feeling that initial minor pain.
Exactly. And on the flip side, they have a small gain. The pleasure is minor, but the fear that this small gain will disappear, the potential loss of that pleasure, is extremely high. So they close the trade prematurely, limiting their potential profits.
They take the small win and run, but they sit on the big loss and pray. This violates every sensible principle of risk management.
It does. To overcome it, you need to reframe your thinking. Accept your stop loss not as a personal failure, but as an operating cost, like the gas in your car. It's part of the business.
That's a mindset shift right there. Let's touch on the final driver, which often happens after the successful shift in mindset, and that's overconfidence.
The euphoria trap. This typically strikes after a winning streak, say 3 or 4 successful trades in a row. The brain secretes dopamine, that chemical rush that generates the illusion of control. The trader starts to believe they are invincible. They think their judgment surpasses the market.
I've seen this happen 100 times. A trader doubles their account, and suddenly they're ignoring all of their own rules.
And they double their position size or they start using excessive leverage. When the market inevitably corrects, they blame the Fed or unexpected news or claim the market was out to get them. They will never admit they violated their own risk management rules because the dopamine has made them feel like a genius.
It's a form of confirmation bias where they only see what confirms their current sense of market mastery. Overconfidence leads directly to negligence and, eventually, the full account blowup. 3 actionable strategies. Knowledge is only half the battle. Let's give our listeners the actionable strategies they need to implement today to defeat self-sabotage. You identify 3 core strategies. Let's start with the first one, which is an expansion of the classic trading journal.